Okay, so we obtained a CAR that is relatively small. We want to try to increase it. If we still want to opt for option A, what can be the strategy if you want to increase the CAR? What are the possibilities? What can we do? Here we have a
Maybe
certain, yes.
decrease the initial investment.
Okay, very good. This is a
Or
good this is one possibility. Okay, we try if you want to get a machine of similar performance with a smaller cost. You know that for the same specifications, you can have different prices, especially depending on the country where you have the production. Okay, so sometimes if you can get same performance with a relatively smaller cost, so if it's made in China, no problem if it's made in China. At the end, you know that the industry of China is developing in a very good way and they have good products. So even sometimes they are able to compete with a production of Europe or of USA. That's why with a smaller price, you can have comparable characteristics. So if you can allow this, so of course it depends on the type of product and on the application. So if you can allow for this, you can try to come up with similar characteristics with a lower price. So the first option is to try to get a similar machine, but with a lower price. Very good. Now, other option. Look,
decrease the maintenance cost if possible.
if possible. هلا المينتنس is little bit limited. هلا of course if you decrease the cost, okay, the maintenance cost also might decrease. But هلا concerning the salary, also you can play in a certain range with the salary. So you can negotiate with the employer about هلا the salary is not for machine A, and you can do this for strategy B. But for A, since you don't have operational cost, you can work on the price. You know that any item, whenever you sell any item, you have a certain range, okay, that you can play with. So depending on the market, of course. So depending on the market, you can study if I increase the price a little bit. So let's say if I want to sell at $4.1, okay, or let's say at 4.2. So a small increase in price will really increase a lot your benefits, because here we are talking about 1,000 items per year. So if you just increase, for example, the amount of the selling price just by let's say $0.2, which is not a very high increase in percentage, okay, it's a 5% increase, you will have an extra gain per year of let's say $2,000. And you can study it, you can do a study, what is the range of prices I can play with. So how much can I increase the price while still competitive, and I should pay attention to still competitive in the market to be able to sell my products. Okay, in this case, each value, yani each price, you can study for each price what will be the gains, the amount of gains that I can have. And in this way, you can decide if I can go through this option or not. So if you consider that this will remain a competitive price, okay, instead of gaining $3,800 per year, your gain will increase to $4,000 per year. And therefore, if you repeat the analysis, you can repeat all calculations for internal rate of return. Of course, if you increase your price, the internal rate of return will increase. So this will make your option more viable. Okay. And also the NPV, okay, the net present value and CAR will increase also. Okay, so you can reach CAR higher than 30%. So if we repeat the calculation with 4,000, you will get the following. You will get that the NPV will become at year end for a discount rate of 5%, it will become 6,855.26. And if you calculate the CER, for your CER, you will get 34%, which is much better, okay? So this is what you can do to enhance the chance of option A, okay? Now, of course, if you increase the price in option A, you should also do it for B, because if you are able to increase to $4.2, this means you can do it for both options. Unless the product specification is different. And here we are considering that the product characteristics will be the same from machine A and machine B. In case machine A will give you better characteristics, you can have a larger price, a larger selling price for A compared to B. Okay. Now, we will perform the same calculation for B in order to decide on which option to take. So we can expect here that the CER of B will be larger, because especially that the payback, that lifetime is really short. Since it's 8 years and the cost is really high for machine A, we can predict that B will be better, but we cannot be sure unless we do the calculation. So here also we'll repeat the same for B. So we'll calculate NPV at year 8 for option B, of course, for a discount rate of 5%. So we just have to apply the formula for A equal 5%. So it's minus 5,000. And we have seen that the gain is just $1,100 per year. And we multiply it by the summation, which is, as we mentioned before, it's the summation S that you can directly use. It's the same summation that we did before from 1 to 8, okay? Plus the salvage value, as that is equal here to 300. Of course, okay, here we can, even if NPV is smaller here, it's not a problem, because what we care for is the CER. Pay attention for this. So the net present value here is 2,308, but this doesn't mean that option A is better at all, because the investment is much smaller in this option. So for B, it's true that we have $2,309.05, but now when you calculate the CER, okay, if you calculate the CER, you will get that the CER, which is the NPV at year 8 over I, which is 5,000, is equal to 46%. Can you tell me why we should compare the CER and not the NPV? I can tell you, but if I use machine A, I'm gaining more money. What can be your argument? Why B is better? Look, if I have $20,000, instead of buying one machine, I can buy four machines of plan B. So if I have the same investment, I can have a NPV. This NPV will be times 4. Okay, this is why I care for the percentage of gain, because if I have a larger investment, I can buy more machines, and therefore my NPV will be 4 times 2,309, which is larger than the benefit I obtained from option A. Okay, so since CER is larger, and this CER was just for a price of $4, if I increase the price to 4.2, I can increase the CER much more. Okay, so I can deduce from my analysis that the IRR analysis and the CER analysis both gave me same recommendation, since also CER of B is larger than CER of A. Okay, and if I have contradictory results between IRR and CAR, CAR is more important, so I opt for the option with larger CAR. But the internal rate of return is important also, so it's good to know at least the range of discount rates that I can work with while still having a acceptable result. Okay. Any question on this?
Question?
Yes.
Doesn't option B also have like it needs an employer to operate it with the higher salary and such?
Okay, look, for option, what is the main difference between the two machines? Machine A
Autonomous
is more, if you want, developed. It's an automatic machine. It doesn't need an employer to operate it. So when it comes to cost, you just first, the investment is really high, but for the remaining years, you don't have to have an employer. You don't need an employer here. So you only have no operational cost for machine A. You only have a maintenance cost to pay. This is why when we did the computation of cost in part A, we just considered that we have 1% of 20,000, which is $200. So you have only $200 as maintenance cost and no operational cost. Okay. While for option B, since the machine is not automatic, you need an operator to run it, you have to pay a salary of $2,000 per year. So for the cost, you have 2,000 in addition to the maintenance, which is 2% of the initial investment, which is when we calculate it, it's $100. So in total, you should pay per year $2,100 as costs. Okay, while for option A, the costs are much smaller, which is an advantage for option A. But on the other hand, the initial cost is really high. So maybe if the lifetime was larger, option A might be more favorable. Okay, so this is why we said the IRR and NPV are depending on several factors, and if we change one of the factors, the decision might change. And if you study your system, instead of for 8 years, if the lifetime is 20 years, everything will change. Your decision will change because machine A will allow you to gain much more money, and you can pay back your initial cost and then gain much more money than B, but you will need a higher lifetime. Okay.
Yeah, that makes sense. Must also, you said we could buy 4 machines with the 20,000 instead.
Exactly, but again, we are comparing for 8 years for a payback for a lifetime of 8 years. Okay, so if the lifetime is now 20 years, everything will change because for 20 years you have enough time to gain back your money. Okay, if I tell you the gain was approximately, okay, we said the gain is $3,800. So if we just want to take an idea, we don't want to take time if the discount rate, the non-discounted payback period. Okay, you need at least, so you have 20,000 over 3,800. You need more than 5 years to just pay back your investment if you don't consider the time effect. So the payback period is at least 5 years point something. Okay, which is really high. If you take the other case for B, if you take 5 over 1.1, it's smaller than 5 years. And already the non-discounted payback period for machine A is smaller than the one for machine B. So this is an advantage for for B. This is why you need more time, and you need to give machine A more time to be able to start to compensate for you. Okay, and since 8 years is really a short period, you didn't have enough time to be able to profit from your high gains, which is $3,800 per year. Okay, so if you have a larger period of time, you can say that you expect A to be a better option. One question can be, what should be the number of years okay, to have an advantage for A over B? This is a possible question. So you can try, for example, you try, let's say 10 years. If 10 years will give a better option, then you can try for 9 years. And you should try what is the number of years that will make a better option than. Okay.
Okay, deal. Yeah, thank you.
Welcome. Other question on this problem? Okay, great. So let us continue. Do you see the PowerPoint?
Yes.
Okay. Now, another important factor to consider whenever we conduct the economic analysis is the debt service coverage ratio. Okay. So let's say you are investing in a project and you need part of your money is from loans. Okay. You need to make sure that you are able to pay on time, because if you don't pay on time, the value you should pay will increase. Okay, so this is why we do a study, if you want, for the debt service coverage ratio. We make sure that we are able to pay on time, and plus we should have additional gain in order to pay back the initial investment. So whenever we perform the financial analysis, we should check if we are able to pay on time the debit plus gain enough money to consider the project profitable. So the financial viability of a project can eventually fail even if the NPV is positive and the IRR is above the hurdle rate. So even if you judge that the project is favorable in terms of NPV and IRR, you should pay attention that you are able to pay your debt on time. Okay, so this can be due to the possibility that the project may not be able to serve its outstanding bills on time. So the liquidity in the investment firm, defined as the ability to meet all financial obligations on time, may not be enough in certain years. So this is why we calculate what is called the debt service coverage ratio. And this ratio is simply calculated as following. It is the net operating income over the debt service cost. So for each year, when you do the financial analysis, for each year, you can calculate what is the net income, which represent, if you want, the net present value at a certain year. In the calculation of IRR, you are just interested in the net present value at the end of lifetime. But when you want to study the financial aspect of your project, you don't only calculate the net present value at the end of lifetime, you calculate it also over the years. Of course, for the first few years, you will get a negative, you can get a negative NPV, because if you want, the benefits will not be able to cover completely, if you want, your initial investment. But if you have taken a certain loan, you say, I don't have to pay all my investment once, I can pay it in fractions. So for the first year, you say, maybe I can pay, let's say, 10% of the value, etc. So you put a schedule to pay your debt. Okay, in case the net operating income should be much larger than the debt service cost, in order to be able to pay on time and also gain at the same time. So in other words, it is the ratio of cash that is available to serve the debit. So the debt service will include interest payments, the repayment of the principal, and potential lease payments. So you know that you have to pay an amount plus the interest. Okay. So if the DSCR is smaller than 1, it means that the cash flow is negative. The project would not be able to generate enough revenue to serve the debit, and the firm would default on the total or on part of the loan. So this is why when you present, let's say, a view of your project for the bank will ask you about the study of the debt service coverage ratio, and it will expect from you to have a high debt service coverage ratio to be able to accept the loan. Okay, so for example, if your DSCR is only 0.8, there is only 80% cash to serve the debit. So usually an annual DCSR is required to ensure the viability of the project. And for banks, they will impose on you when you present a study of your project, they will impose a DCSR between 1.15 and 1.35. And higher this ratio, the better is, because you will be able to pay your loans and at the same time have a profit, start to have a profit. Okay, so for example, let's say if we have a certain project and we are presenting for different years what is the debit balance that is expected and what is the NPV. So also we have what we call the loan life cover ratio. It's a summary measure, so it's similar to what we discussed above. It's a ratio between the cash flow available and the debit outstanding, and it should be larger than 1. And if we do, for example, a project on 5 years, we can see here that this ratio was 1.56 for the first year, which is good. So we are able to pay the debit. It is equal to, all you have to do is the ratio. And here, for year 1, you say, I will divide the amount of cash that I have by the debit that I should pay, which is $500. So I have an excess, which is good. So the excess, I can use it as a profit or to pay, let's say, something else. So I have a ratio of 1.56, which is good, let's say, larger than 1.35 for this year. For year 2, I do 717.62 over 400. It's also acceptable. But for example, for the 5th year, okay, the value dropped a lot. It can be maybe because of time effect, because of the discount rate. It might be because the income is decreasing, and you know that the income can vary with years. Sometimes it can, the income can decrease plus the time effect. Okay, and you might not be able, let's say, to pay your debt. This is bad. So in general, what we try to do, in case when doing the study, we obtain that for a certain year we have a failure, we say let us pay before. Okay, because if you reduce the time of paying the debit, you will reduce also the interest that you are paying. Okay, so you can do a schedule that can help you to decide what is the number of years that is good to pay my loan within. And no need to have to repay just for the whole time, because if you increase also the time of payments, you will increase the interest rate that you are paying. So you can do like an optimization study in order to decide on the schedule of payments, in order to ensure always a ratio larger than 1.35. So in general, as we said, for this ratio, it's recommended to have a high value for the ratio. For example, if the LLCR is smaller than 1, as we said, this means that the project free cash flows are not sufficient to support the amount of leverage that is being modeled, and it will therefore be unable to service the loan within the loan life. Okay. On the other hand, if it's larger than 1, this will suggest that the project cash flows are sufficient. Now, in general, as we mentioned, to be on the safe side, we suggest large values of LLCR. So if you have high risks, for example, in a certain project, you can go to larger value of LLCR to be able to compensate the risks that you might encounter. So if we take the example above, from year 1 to 4, the ratio was acceptable, but in year 5, you were not able to pay back your debit. This means that you don't have enough money to pay the interest for after 5 years. So this will suggest for you to have your payment during the first 4 years instead of waiting to year 5. Okay, so as the cash flows in the previous years are higher, it could have easily been sculpted such that more of it was repaid in the earlier years, allowing then the LLCR in year 5 to be higher. Or you might say, I don't want to wait until year 5. I want to pay everything in the first 4 years because I have favorable LLCR. Now, as we can see, the financial analysis is really complex and it depends on several factors. That's why in general, we don't say A is equal to 5% and it's done. We need to perform a sensitivity analysis. This means that we want to study the effect of variation of parameters. So the term sensitivity analysis describes the simple process of establishing the extent to which the outcome of the financial analysis is sensitive to the assumed values of the inputs used. This means that, for example, I have a project. I am not sure if you want, what is the type of investors I can suggest for, what is the country I should invest in, etc. I want to do a small research to see what is the most appropriate parameters. So first I say I can try several discount rates. Okay, so which is, if you want, similar to the approach of calculating the internal rate of return, because calculating the internal rate of return will allow me first to determine a certain range of discount rates I can work with. So if I have a much larger IRR, this will make my project, if you want, favorable to different investors, because larger the IRR, this means that I can propose my project to investors that that expect to gain a lot. So because important investor will impose a cost of capital that is much higher, while if for a small investor or a beginner, maybe it will accept to work with a project with a relatively a small discount rate, because if you are new in the market, okay, you don't have a better option. But if you are an important investor, you already have investments that will allow you to gain a lot of money. So you'll not go through a project unless you expect to gain more than the other projects. Okay, this is why higher internal rate of return will help you to expose your project to different investors at different scales. Plus, an additional issue is, as we mentioned, the selling price, for example. We can study a certain range of selling prices. So we should study the market. We should know what is the range of prices we can go through. If I reduce the price, it's true that I will reduce my income per item, but also I can have a larger number of items sold. Okay, so deciding also on the number of the productivity will be affected by the sensitivity analysis you can do. You can say, let's say, if I increase the productivity, I can decrease the price, but I can gain because I will have a larger income. But at the same time, I should pay attention that my machine might need more maintenance. So all of these factors are related, and I need to perform sensitivity analysis. I can fix let's say, several parameters and vary one to see how it will affect my financial analysis. And based on this, after I do this for the different parameters, I can come up with like an optimal result. So I can decide on the price, on the selling price, on the amount of productivity, on the discount rates, or the range of discount rates that I can play with, etc. So performing a sensitivity analysis by varying only the discount rate constitutes one commonly used method of taking risk into account. And this will allow me, if you want, as we mentioned, to decide on the range of condition I can work in. So let's say, as we mentioned, if we can only work with small discount rates, we have certain types of investors to work with. If you can work with larger discount rates, you have other investors. And also it will depend on the country where you invest, of course, because the situation of the country will affect a lot your decision. So under this approach, if a project is believed to be more risky than usual, the analyst will use a higher discount rate than that which would be used in the absence of risk. Because when you have larger risks, okay, you can consider I might have a reduction of income, so I should take into consideration a larger value of income. Now, providing the decision makers with NPVs for a given project over a range of discount rates will provide the information that is required to assess the significance of applying a risk premium and deciding whether the project is marginal or not.